Hi, welcome to Atlas Crossings. And today we're looking at something that I believe is theoretically important and relevant to everyone. Investment. This is where your money grows and works for you. Whether you're a newbie or you're here just to brush up your skills in investing, this content is relevant for you. All right, let's kick things off by starting with the relevant question: what is investing? As individuals, we can engage in work using our own skills and capabilities to generate a steady source of income, whether through wages or salaries. The income we receive, we can use that to pay for our expenses, our bills. We can save some of that, or we can invest some of that. With investing, we can grow our wealth over time, getting our money to work for us. Simply put, investing is the process of putting your money to generate more money for you over time. It's about making your money work hard for you and possibly work harder than you do. Now, here are 5 basic things you need to know about investing before you start investing. Setting financial goals. Before jumping into the nitty-gritty of investments, it's crucial to set clear financial goals. Ask yourself the question, why are you investing? The income and money you generate from your investment, what do you intend to use that for? You want to use that for retirement and early retirement. Some people want to retire at the age of 30 or 35 or 40. Or do you want to put that into buying a new home, the home of your dreams? Or maybe you want to go on that dream vacation. Investing can help you to achieve some of these goals, but it's important to set clear financial goals. Because knowing what your financial goals are can help guide what your financial and investment strategy could be. It helps you build what we call your investment objectives. And we've covered investment objectives in the previous video, so I'm going to put the link in the description so you can go back and watch the video on setting investment objectives. You also want to decide if you want a steady income provided by your investment, or if you're just happy to see your capital investment actually grow. So you can receive steady income, or you can experience a capital gain or capital appreciation of your investment. But of course, you can want both income and capital appreciation. Your decision will guide the sort of assets and investment options that you put into your portfolio. Understanding risk and return. Investing involves risk. It also involves return, but it's important to understand the relationship between risk and return. Generally, in finance, higher risk typically leads to higher rewards. This also entails that low-risk investments will likely generate low return. But of course, higher risk does not always translate to higher returns. The lower risk investments could generate higher returns over a longer period of time than higher risk investments. But it's all about finding the right balance that aligns with your risk appetite, your risk tolerance level, and the financial goals that you have. The good thing today about investing is that there's a wide range of investment assets to invest in, and each has its own characteristics which you need to take consideration of. Traditionally, we have stocks, which are also known as equities and shares. Investing in stocks means that you're buying a percentage ownership of a company. We could also buy bonds, which means that we're loaning out money, we're giving out money to the issuing authority. We can buy government bonds or corporate bonds. Mutual funds and real estate also provide another traditional form of investing. With mutual funds, money is pooled together from different sources, from multiple investors, and is then managed by a professional fund manager. While real estate allows you to invest in physical assets like residential properties, commercial properties for rent or to resell. But there are other investment instruments such as commodities, hedge funds, crowdfunding, venture capital, private equity, and cryptocurrencies. But you might also have heard about people investing in watches, people investing in winery, people investing in paintings, people investing in vintage cars, in movies, films. These are a range of alternative options that investors have access to. Many of these investment options sound fun and enriching, but there are different entry and legal requirements to participate in these different investment options. And if you're a potential investor, you've worked and saved minimal resources to invest, some of these investment options might be out of reach. If we take stocks as an example, the entry level is probably the easiest entry into investing. You can begin to buy shares today from where you sit watching this video. Many years ago, if you needed to buy a stock, buy a share of a company, you had to call a stockbroker to ask, or to place an order into buying any of the shares that you wanted. But today, there are several trading options and trading platforms, even online banks, that allow you to gain access into the stock market. Through these platforms, you can buy securities and sell securities on a daily basis at little or no cost. Investments can actually start with as little as $1. And this has been made possible by what we call fractional shares. So investors can potentially buy fractional shares, a fraction of a full share. You can make money by owning shares that pay out dividends, which generate income for you, or you can see the share value of your share go up. In this case, you experience capital gain. So if you buy a share today that is $1, and let's say tomorrow it goes up to $2 and then you sell, you have experienced a capital growth of $1. Diversification. You might have heard the expression, do not put all your eggs in one basket. Well, that is simply the principle of diversification. Diversification remains an important strategy in reducing and mitigating against risk. It entails spreading your investments across different asset classes that help to reduce poor performance of the entire portfolio. Remember the different ranges of assets that we talked about: stocks, bonds, cryptocurrencies, venture capital, private equity. All of these assets bear different levels of risk. And so they will react to the market in different ways. Long-term versus short-term investing. Investing is a marathon. It's not a sprint. Long-term investing allows your money to grow over time, taking advantage of compound returns. Long-term investors are like passive investors. They identify assets or an index and buy and hold the assets within that index. Long-term investors are like passive investors who buy an asset and watch it navigate different market conditions. You'll find long-term investors putting their funds into an index like the Vanguard S&P, the S&P 500, the FTSE 100, or simply picking top performing stocks and buying and then holding them through different economic times. Short-term trading involves frequent buying and selling of securities. This can actually be riskier and can require quite a lot of time and careful attention to identifying the different assets being bought and sold. Active investors are keen to always try to buy and sell assets in reaction or to reflect the market events. Some investors adopt both a short-term and a long-term strategy, both an active and a passive management strategy, what we call core satellite investment strategy. They could have some assets and securities that they buy and hold for a long time, but have some committed resources, some committed funds to take advantage of short-term opportunities within the market. It is important to note that in investment, the same way we anticipate our wealth to grow is the same way there is high level of risk and a potential that we will receive less than what we have invested. And there you have it. That was a brief overview of the basics around investing. Remember, everyone's financial journey is unique. So take the time to educate yourself and make informed decisions. Found this content helpful and relevant, hit the thumbs up and click the subscribe button. And don't forget to continue to show up.